Welcome to the EcoTeq Academy webinar, Navigating Fleet Transitions, CapEx versus OpEx. Today we have Michael Roocroft from Credit One, who will be helping us to understand financing equipment. Michael has 5 diplomas and certificates across both the business and finance sector, and Credit One hold accreditations with more than 40 banks across Australia. We will be answering questions at the end of this webinar. Please feel free to post questions in the chat. Thanks again for joining. Handing over now to Michael.
Beauty. Nice to meet you, everyone. Thank you for the opportunity first, EcoTeq, for having me aboard. Hopefully I can provide some insight, into how we can assist, both councils, private businesses, small businesses across Australia. I have 4 years experience working for Credit One Equipment Finance, and we finance everything from plant equipment, ag equipment, construction equipment, and even small business loans as well. Hopefully we can give you a bit more insight today and help out your business and find a little niches there that we can work on together.
Thanks very much, Michael. We'll get straight into it. So just to kind of set the scene, I guess, a little bit, there's a few common themes that we're coming across, the challenges with acquiring new equipment and areas that lease may actually help. But the first one's obviously the most straightforward. It's budget constraints, whether that is not having the budget that you're needing up front, obviously setting at the start of the financial year, or whether that might be you're having the right budget set and then you have machines break down. Obviously, you're drawing out of that budget, and then by the end of the year, you haven't got anything left in there. There's also conflicting capital equipment priorities. So this is where we've got let's take, for example, a council might have a set budget for fleet expenditure, and then we've got different teams. So you might have the waste team that's needing equipment. You've got the parks team that's needing equipment. You've got other assets teams, maintenance teams needing equipment, and trying to work out how we, share that capital around with conflicting priorities there. Then the third one is probably the nicer one, but it is still a roadblock where you've got the cost of growth. So what we're finding is contractors are winning work. So contracts with councils or defence or education might be a 5-year contract. So they get paid the value of that contract over the 5-year period, but they've got to fund the growth of capital equipment, starting tomorrow. So they're the 3 common things that we come up against, Michael. So I'm hoping you can help us answer these questions and how we can best get around them as we go through. But did you want to give us a bit of an overview on financing?
Yeah, definitely. Just a brief, obviously, rundown of financing. There's a couple of options, which are the main options for businesses out there in Australia. We've got your chattel mortgage and we've got your operations lease. That's what's going to work best for you guys. And these are some of the things that it does help out with. It gives you, obviously, quick access to the equipment that you need. It allows you to have a predictable cost over the period of these loans, which range from anywhere from 1 to 5 years, which obviously helps you fit into those budgets, or business cash flows to make sure it's affordable for your business. Obviously, when you're purchasing, revenue-producing assets, you can spread that cost across your business. You can limit the finance cost to make it nice and low, as well as, produce that high income every month where it makes it quite affordable and makes it more sustainable for your business. One thing that separates the chattel mortgage and the operational lease is an operational lease will not be included on your balance sheet, which will leave that asset out of there and make it look as though your business generally owns more, but sometimes that's what you want in a business, as it allows you to expand further and get other assets as well. If they put it on the bank's balance sheet and not your own business balance sheet. So that's a way you can figure it out, and especially discuss that with your accountants on what option might work best for you.
So what would be the benefits of having it on the bank's balance sheet rather than in my own? Because I always thought having an asset in my name could be a good thing. What would be the benefit of not having it on your balance sheet?
Some of the benefits, you don't have to pay a lot of the GST costs. So
Sure.
You'll save money on not paying the GST. not having it on your balance sheet, which will obviously cause you more taxes at the end of the year. The other side of it, if it is on your balance sheet, you will be able to claim the depreciation of the asset, not the full amount. Usually, I think it's about 25K a year at the moment from the government's provided. And you'll also be able to claim the interest on the loan as well, if it's on your balance sheet. But if it's not, you won't just be able to write those things off. You'll have to find other ways to write stuff off your balance sheet.
Yeah. Okay. Fair enough. Fair point there. So you mentioned the two different finance options, or the most common finance options. Can you give us just a basic overview of the differences and what might suit what application better?
Yeah. Start with your chattel mortgage. Around about 90%, most of my customers, or most of the loans most people hop into, are chattel mortgages. It's a fixed term contract. Oh, just cut out of there a little bit. You cannot include the maintenance onto these chattel mortgages as they are fixed. You can't pay down the loan throughout the 5 years, but you can pay it off at any time. And it just means that it is registered in your company name and it will be on your balance sheet at the end of the day.
Okay, so you're saying you can't pay it down faster by putting more against the loan, but you're saying you can just pay the loan out at any time.
Correct, yeah.
Sure.
Which makes it, it's more of an incentive for the bank in some sense. But when you do decide to pay the loan off, they will give you a discount on the interest remaining, usually about up to 30%.
Sure.
Your operational lease, a little bit more flexible, used by a lot of councils out there and sometimes a lot of public businesses. It means it's a flexible contract. You can include your maintenance and parts servicings throughout the 5 years. Some of the different things from a chattel mortgage, you will have to pay one extra payment at the end of the loan to own the asset and put it in your company name. But throughout the operational lease, it will be under the bank's name. So technically they will own it and you'll be leasing it off the bank throughout that period.
So to put that in simple layman's terms for people like myself to understand, essentially the chattel mortgage is I'm buying the equipment, but I'm getting a loan to finance it. Whereas with the operating lease, the bank buys the equipment and I use the bank's asset and pay the bank a lease for the equipment.
Correct.
Is that right?
Yes.
Cool. But then with the operating lease, obviously you've got parts and maintenance and stuff you can include in that lease arrangement.
Yeah, it is a lot more flexible on that end. You have those options.
Sure.
And if you didn't want to buy it back, they do give you that option as well. It's a little bit more flexible.
Yep, sure. Okay, cool. So some of the benefits of financing, you put these together, Michael, so I might get you to run through this, but the exposure with banks, I don't have too much knowledge on that side. It's more my CFO side of the business that deals with all this stuff. So
no worries. I'll try to keep it nice and brief. The benefits in financing, you're allowed to spread the costs of what you're looking to borrow across multiple banks. There are more than 40, 50 plus banks out there. Obviously some better than others. But if it gives you that opportunity to expand your business. You can purchase the equipment you couldn't afford with cash. No one's got $500,000 just sitting around ready to go sometimes. So, you finance it, you allow it to produce the revenue for you, and then it allows you to expand your business, get those working contracts, and keep obviously going from there. The more you bank with these banks, the more loans you continually do, you start getting those preferential rates. Starts to get a little bit cheaper for you. They take care of you a bit more. As with most businesses out there, your repeat customer base is the foundation for everyone. That's probably the main benefits of it. It allows you to spread the costs and just work on getting those other business contracts. You do have to pay obviously the slight fee of the interest, but at least you can claim that back at the end of the year in the tax time.
Sure. And also probably the biggest thing is you can afford the equipment now rather than waiting for the next budget to come around and hoping it's in there.
Yeah.
Cool. And then, but there is some risks involved. What we're finding is if people are looking to sell out the equipment early, they've obviously got to pay out the remainder of the lease and the interest. So it is important to make sure that the equipment is the right equipment for the job. You have selected the right thing. Higher maintenance equipment. So when you've got a lot more maintenance and parts involved in it, it can be a bit of a risk. You run us through the finance value over 250K.
With finance values over 250K, that's sort of the benchmark for a lot of the banks out there in Australia. If you are financing goods below that amount, you won't necessarily have to provide financials. So any tax returns, any company financials, any bank statements. It's pretty easy to get a loan for a primary asset such as an EcoTeq mower, a truck, or an excavator, to get an approval without using any financial backing for the company. Obviously, if it's over, every bank is going to ask for some financial statements, some tax returns, some ATO portals, just stuff from the accountant to make sure it is affordable for the business. But when you're starting out, if you can put a deposit down to bring it under that amount, it's quite beneficial and makes it a lot easier moving forward to allow you to grow in those first couple of years.
Yeah, cool. Fair enough. And then the last point there, the leasing quickly depreciating assets. So from my view, that's essentially if I've paid off half the machine, but the machine's depreciated to less than half its original value, essentially I then owe more than what the equipment's worth. So if I had to pay it out and sell the piece of equipment, essentially I'm not even gathering what I've still, like I'm not even selling it for what I still owe on the machine. Is that right?
Correct. That's right. Yes. Yeah, that usually is the case. If you decide to sell it within the third year of the loan, of a 5-year loan, then you do have to obviously pay the payout cost at that time, plus the interest on top of that. So depending on the machine, it might not value up well to sell at that time. So just make sure you've got, you've spoken to the right people to get a good understanding and to move forward and make sure it fits within the business.
Cool, no worries. So where it works best, what we've found in the fixed term assets, so maintenance contracts with a fixed term, as we touched on before, obviously that allows you to spread that cost right across the contract. So you might have a 5-year maintenance contract. Obviously putting that equipment on a 5-year shuttle mortgage will obviously allow you to spread that cost over the contract. So as you're earning the money, then you're paying it down and it's not a big hit to your cash flow, which can be quite detrimental to businesses. Or on equipment with a replacement schedule. Michael, you said, as we were talking earlier this morning, you mentioned replacement schedules work quite well with these leases because essentially you're just rolling over the lease to a new piece of equipment. Do you want to explain how that works?
Yeah, definitely. For example, if you've already had a loan which has been going for 5 years and that machine's starting to get a little bit older, you're looking to replace it to get something else. If you find a machine that is quite similarly priced or a little bit more expensive, you can put that on a replacement loan. It pretty much just replaces your old loan with the new loan, and then you can extend that over 5 years. Sometimes if you sell that asset, you can use it as a deposit to pay it down as well, which will make it a lot more affordable, and you can quickly just go from one to the other without wasting too much time in the middle for your business.
So essentially a lot less paperwork, a lot less approvals. It's just rolling the loan across and pretty simple.
Correct. Yeah,
it's good.
Just moving one from the other.
Yep. Then the battery electric vehicles and plant. So obviously where this works is if you've got lower running costs, essentially the repayments fall into what would normally be your fuel and your maintenance for diesel vehicles. So you probably actually won't notice much of a change in your, again, it depends on your utilization. If it has got high utilization, you won't notice much of a change at all in your OpEx because the repayments are coming out of your OpEx budget, but the fuel and the maintenance is not. So it should balance out. But you had a point with the cheaper rates for EV, which I found interesting. Did you want to go through that?
Definitely, yeah. So a lot of the bigger banks in Australia now are starting to introduce lower rates for EV products, whether that's cars, mowers, any sort of vehicle. Obviously, because it's eco-friendly, it does give a little bit of a good nudge to the banks. Obviously, they do have a bit of bad press around, so it's a bit of a branding point for them. But they are sort of giving those promotional rates out and quite a big discount to about 0.5%. Um, yeah, which is good to see that they're supporting it.
Yeah, cool. So it's not so much then that it's costing them less or anything like that. It's just they're trying to promote it for a bit of a feel good thing, is it?
Yeah, so I'd say so. The banks can always afford it, so it's
Yep.
just
Okay.
trying to get them the good books as well, but
Take
also
advantage of
trying
it
to do
then.
something good.
Yep. Cool. No worries. We had some other tips in here. Um, so reducing finance below 250. I'll give a basic example on this. So essentially, if you've got, let's take a current diesel street sweeper, your replacement budget might be 200K. You're wanting to look at electric options, or let's say the new diesel one's 250. You've got 200 in the budget. What you can do is essentially put that whole 250 against the as a down payment. Sorry, put the whole 200 as a down payment. So you're only leasing 50 grand, which is obviously a low, very low lease. So repayment's going to be very low. Or if you are wanting to stretch up to the electric machine, essentially, if you're putting that 200K down payment, then you're spreading 150 grand as a lease across the next 5 years. So that 150K, when you take that into account with your operational expenses, that could be probably lower than what you're normally paying on fuel and maintenance. But when you're reducing that finance below 250K, there's obviously a lot less paperwork and a lot less accounting hassles to go on with it. Is that right?
Correct, yes.
Probably the longest way you could possibly explain it, but same with mowers. Say, for example, or cars. If you've got a vehicle replacement at 50 grand, and the electric option is 75 or 80 grand, put down your 50 grand as your down payment, lease the next 30, 35 grand. What's the lowest lease amount banks would do?
Um, the lowest lease, mate, you're probably looking around sort of 10K.
Yep.
That'd be both with chattel mortgage and a lease.
Yep. Okay, so it is possible to have lease arrangements on quite a small figure.
Yes, if needed.
Yep. Not that you like it, but that's all right.
Yeah.
The other point is ensuring the equipment is fit for purpose. So first thing I will say is new equipment is better because there's less risk for banks. There's less potential maintenance problems. Generally, they'll be within warranty. But surprisingly enough, we do find quite a few people looking to purchase equipment that is not necessarily fit for purpose. They think it's shiny and it's cool. So what I would say is make sure you've done your homework on it. Make sure you've talked to some people that potentially already have the equipment. Talk to, whoever the seller is of the equipment. Make sure that you've done some trials, because what you don't want is the equipment you don't want to have to move the equipment on halfway through a lease. It just adds a lot more stress having to pay things out, and paying that extra interest if it's not something that is going to work moving forwards. The low dock and full dock options, I don't really understand that. Michael, can you run us through this?
Yeah, definitely. There's two type of options with
Sorry, looks like we've lost you again.
oh,
Yeah, sorry, I got you back again.
yeah, right. Yeah, low doc, no financials from the accountant, no bank statements. Usually this can only be done about under 250, sometimes under 150, depending on the bank. And obviously your full doc options are using full financials, last 2 years tax returns and financial statements for the business, ATO portals, and pretty much, yeah, a full document application, which sometimes takes a few days longer to go through. So,
Yeah, sure.
low docs are quick and easy, full docs are
Yep.
a bit longer, a lot more in depth.
Yep, cool. The other thing that we find as a bit of a roadblock in this is with stakeholders, change management, getting people to look at both sides of the coin. So obviously everyone understands outright purchase, CapEx budgets. If it falls in your budget, you've got the money for it, you buy it, run it for another 5 years. In the meantime, you're saving up, which is fine. Changing across to looking at financing arrangements can be a bit of a challenge, especially if it's something that we don't understand, like myself. However, what I would say is involve your finance teams early. Reach out to others who do run finance arrangements. I'm sure our CFO, I know he's a busy man, but we finance all of our rental fleet. So people like that, reach out to those people, figure out how it works when you're looking at, revenue earning equipment or just general maintenance equipment. And then the last point there is consider having some external people run fleet modeling if you're looking at a full transition, because changes to your fleet can be a process that can take, over 5 years. So make sure you're getting help to set it up. Is there any other points on that, Michael?
No, I think you've pretty much hit it. Yeah, dead on the head, man.
Sure, no worries.
Yeah.
That's all good. We have bounced through it fairly quick, so we do have a few questions which I might run through.
Yep.
One was we've got Gavin Hughes says, with one of the proposed benefit of leasing being the ability to claim the interest costs back on tax, is this not applicable to government? This is not applicable to government bodies, is it? As we don't make profit to reduce with tax expenses. Can you help on that one, Michael, or is it something we'll go back to Gavin about?
I will double confirm that. It's probably obviously a little bit more of an accountant question. But from my understanding, yeah, I don't think it's acceptable to government bodies. I'm pretty confident, but we will get back to you on that one.
Cool, no worries. I would say if you're not paying the tax, well, you probably can't claim the tax potentially. So it depends, but we'll come back to you on that one, Gavin. It's a very good question. We should be looking into that. There's another question here that's come through. Is there any limit to down payments or balloon payment percentages to reduce your monthly repayments?
Yes, great question. There isn't a limit to how much you can put down as a down payment. You can put down 30%, 40%, 50, even 80 if you really wanted to. It's up to you at the end of the day. And with the balloon payment percentages, a balloon is just a residual at the end of a chattel mortgage. So you can do, say, 30% of the asset price of 100K. So you'll pay 70K throughout 5 years, and then you'll pay the 30% after that for an extra 2 years. Or you can refinance it over 2 years, or you can just pay it dead there of 30% of the asset cost.
Sure. And is that on an operating lease or a chattel mortgage or both?
Just on the chattel mortgage.
Yep.
And obviously, yeah, it will help reduce those monthly payments. If you do take that balloon out.
Yep. Okay, cool. So it sounds like the chattel mortgage is probably the most, in a way, it's a fixed contract, but it is the most flexible with what you can do with it potentially.
Yes, yeah, before you've obviously signed it.
Yep. And we've got a question come through from Anthony, which is probably more back on myself, but you could answer this one. Who does the maintenance for an operating lease, council or the bank's mechanics? So essentially what he's saying is they're paying the bank, so the assets in the bank's name in an operating lease, they're paying the bank for maintenance, and then the bank would be dealing with whoever the maintenance contractor would be. Is that correct? So yes. Say, for example, if it was EcoTeq selling the piece of equipment, the customer, or Anthony in this case, would then talk to the bank and say, we need the next scheduled maintenance. The bank would then send a amendment purchase order or something to EcoTeq. EcoTeq would do the machine, and that would just be charged through the normal lease. Is that, am I getting that correct?
Yes, that's correct. Yeah, that's the way it's done.
Yep. So if council were to maintain the machine, they wouldn't necessarily need to claim that through the lease, would they?
No.
Correct. Yeah. So it'd only be parts at that point. If you were doing your own maintenance, it would only be parts that you would put through the lease.
Correct. Yeah, you can include parts in there as well. But yeah, if there's no maintenance needed.
Yep. Sure. No worries. I think that's pretty much it. I think that wraps us up for the questions, unless anyone had any others. But we will reach out. Feel free to get in contact with the either Michael or myself. Sean was hoping to be on today, but he does send his apologies. So yeah, feel free if there's any other questions to reach out. More than happy to help out with regards to leasing or finance options, or any other questions with regards to the equipment. Appreciate everyone's time.
Thank you. Thanks for having me.